Welcome to the Long Put Masterclass. My name is Stephen Cox and I'm the CEO of Share Navigator and I'm a full-time options and futures trader. This is episode 1 of 6 dedicated to the Long Put Masterclass. This is a bearish strategy. This is where you want the share price to fall for a stock. And we're going to show you the mechanics of a long put option strategy, the risks, the rewards, and everything you need to know to be able to place a long put successfully. So let's get started. So let's define what a put option is. So a long put is when you buy a put option and it gives the holder the right, but not the obligation. The key word there is not the obligation because you don't have to go ahead and sell these shares. And it's up to 100 shares per contract. So that's an important point, that one contract in the options market equals 100 shares. So if we bought one put option contract, it gives us the right to sell 100 shares of the underlying stock at a specified price, which is known as a strike price, on or before an expiration date. We pay a premium for this right. And then when we hold this put option, we want the share price to fall below our break-even price. And why is that? Because if you look at this fairly simply, we have this contract that allows us to sell the stock at a certain price, which is much higher than where the share price is trading at. So as that share price continues to fall, this piece of paper becomes more and more valuable because it allows us to sell the shares at a much higher price than what the share is trading at. That's why the put option benefits when the share price falls. So here's a real life example with NVIDIA. So today is October the 28th, 2025. NVIDIA was trading at 193.02. And we went into the put options market to have a look at what the quotes were. So you can see here, we're looking at the January 16th, which is an 80-day expiry. And we're going to focus in on the $218 strike. So that's the agreement price that we get to sell NVIDIA shares at. And we'll explain why later when we get to trade management. Why did we pick that strike? And you can see here that the bid-ask spread here is $30.25 to $30.55. So we actually went ahead and placed that trade and we got $30.40 and we haggled with the market to get that. So we'll explain that again later on as to why we chose this particular contract. But now we can start getting into some of the break-even numbers and the profit and loss, what it means for you if you did hold this contract yourself. So now let's look at our maximum risk in this particular trade. And that's simply the amount we paid for the put option multiplied by 100 per contract. So we paid $30.40, multiply that by 100, and we get $3,040. So that's the maximum amount we can lose if we bought this put option on NVIDIA. And remember, NVIDIA was trading at $193.02 when we placed this trade. So we need to figure out what our break-even price is. And that's equal to the strike price, which is our agreement price, which was $218, minus what we paid per share for the put option, which was $30.40. And that equals $187.60. In other words, we need NVIDIA to trade below $187.60 at expiry in order to make money on this particular trade. So that's not a long way from where it's currently trading at this moment in time. And what about our maximum profit? Well, that's said to be unlimited. And the reason it's said to be unlimited is because the more the share price falls, the greater the profit we're going to make. So the further it falls below 187.60, the more and more profit we continue to make on this particular strategy. Therefore, the profit is said to be unlimited. Okay, so in summary, we've set the scene now. We're going to use NVIDIA as an example. Maybe we think the AI trade is coming to an end, or maybe other players are going to start eating into NVIDIA's profits. So we've maybe decided that, you know what, we think the share price of NVIDIA could fall. So remember, today was October the 28th, 2025 when we placed this trade. NVIDIA was trading at 193 and we bought a $218 put option and we had a break-even point there of 187.60 and there was 80 days to expiration in this particular trade. So let's see, does NVIDIA fall? In the next video, we're going to do a comparison against traditionally shorting the stock and why maybe buying a put option is a better route than actually shorting the stock outright. But if you would like to fast track your learning, why not consider taking a free trial of our mentoring service? This is where I would work with you one-to-one, establish where you're at your level of experience, and start building on your knowledge from there. You will have access to me and to other members of Share Navigator on a daily basis, And you'll also learn from our real-life trades. We share all of our trades with video updates every day as to what we're trading, why we're trading them, and when we're exiting them. This is the best way for you to learn. If you would like to take a free trial, please reach out. No obligation. We'll have a one-to-one web meeting for 30 minutes, and you can assess then whether our mentoring service is right for you.